Okay.
All right, we are trying a new thing. We're calling it Market Structure Mondays, and I will
I
bring
like
in our
that.
guest.
I like
Yeah.
that.
Oh, it's catchy, right? All right, Tim Quast is our guest. He's here with us now. He's the founder and CEO of Modern IR and Market Structure Edge. Tim, welcome.
Good to see you guys. Happy New Year. It's been a while.
It's been a hot second. How did the end of the year treat you?
To a bunch of skiing. You see, I'm even
my
wearing
goodness.
a little free advertisement for Spider. You know, you got to have your Spider gear if you're out on the slopes. So I was out just about every day.
Where are you right now?
You know,
Where are you?
I'm in Steamboat Springs. So
Beautiful.
we're here about half the time. And it's the fun half, and it's the half when my blood pressure is lower. So we do it as much as possible. How about you guys? Fun stuff, or you're so focused on the markets? There's no time for
There's no time for fun.
rest. No, there's the.
I have a 3-year-old, a 6-year-old, and a full-time markets job, and that's pretty much it. It's kids and stocks. That's pretty much what I have time for. My kids get a little bit older, and skiing might be in the cards, though. So the 3-year-old's not going to do that well on the slopes yet.
So you hate
Maybe
it
she would.
when the holidays come along and interrupt your focus on the markets. That's the trouble.
I feel like I've been on holidays for 2 months. I came back in, I was like, I didn't even know what's happening in the markets at all. All I knew was that Bitcoin was making new all-time highs. So
incredible, right?
Yeah. What are your thoughts on crypto? I mean, before we get into equity market structure, I mean, you can talk market structure on anything, and the crypto market structure is if there is any market structure, it's very interesting to say the least. What are your thoughts on crypto?
It's a reflection of people's concerns about the dollar. That we cannot continue to increase the supply of the dollar without folks looking for some way to hedge the risk that the dollar continues to weaken. You know, there is no question that the single most reliable input on how the equity market, how the oil prices, how Bitcoin will behave is the US dollar. And it varies inversely with the value of the dollar, those things do. That's simple to me.
Yeah, I completely agree with it. It's what I was actually talking about just off the hop. I mean, are you concerned about inflation at all, Tim? Because they tell us there's no inflation, but yet I see all asset prices inflating around us here. Is there a concern from your camp about inflation?
Well, yes, and I've had these discussions with a variety of folks a lot smarter than me. And my view is we have to redefine how we measure inflation. We measure inflation the way that we did when we decoupled from the dollar, which is entirely irrelevant and illogical. It's not the correct way to measure inflation. Inflation is very simple: low interest rates. Low interest rates are inflation. They're not signaling the possibility of it. They are evidence of it. You cannot use the way that we measured inflation in the late 70s and early 80s after we left the dollar in 1971 as a way to understand its presence today. And there's an old economic principle that we forget called Gresham's law, which says that if you try to treat two forms of money that are disparate as having equal value, let's say cash and credit, that people will hoard the one and spend the other. And so look around. What have we done? We've exploded debt. That's spending credit. And where do we hoard cash? In risk assets like Bitcoin. It's evident everywhere. And at some point, there'll be a reckoning. And there's a tie into market structure there, by the way, equity market structure.
Talk to me about that tie-in.
So if you want to understand what is going on in the equity market, where we have all-time highs in the midst of a global pandemic, which is irrational. I don't care how, all these pundits sit around and try to come up with explanations for why what is occurring in the equity market is entirely acceptable. And look, Market Structure Edge is all about finding ways to make money in a market that behaves irrationally. In the last 20 days, active money has averaged less than 10% of trading volume, 9.3% in the S&P 500. First time in history that active investment behavior, rational thought, has been less than 10% of the trading volume. What that means is that over 90% of the time, the market is a reflection not of something rational, but of something short-term, asset allocation based or trading based. And if we don't factor that into our thinking, both public companies and investors, we're going to get caught out. And there's an explanation for why the market is way up. And it's three simple words: exchange traded funds. And everybody wants to say this, but there is a mathematical reason for it. We're all about math. And so through November 2020, there have been $5.2 trillion of ETF creations and redemptions. It's important to note both of them. There are also $5.2 trillion in US ETFs. So that means that the entire asset base in ETFs has been created and redeemed with a month to go for statistics. And here's the kicker. There are $470 billion of ETFs created and redeemed every month, and over 400 billion more creations than redemptions. It's the same thing as creating currency. If you continue to create more currency that depends on an underlying asset class for prices, what will happen to the asset class? It will increase in value until some point, to quote Stein's law, Herb Stein, father of Ben Stein, who said, if something cannot last forever, it will stop. Well, when does the creation of additional currency to inflate the underlying asset price from which the prices are derived stop? We'll talk about that next time. I'm going to tease.
You're teasing us.
Oh man, this guy is good.
I was like, just get to the beat.
Well, because we got a limited amount of time, right? So I want to say there are two things to me that are great teases for next time. I got a note from one of our Edge subscribers who's trading options, and he's producing a 2,600% annualized return, putting $5,000 at risk, trading options only 2 or 3 days at a time, using Edge to figure out what stuff to buy. And I'll talk about that next time too. But I do want to, it all comes back to, why does market structure matter and what is it? Market structure is the mechanics, the physics of the stock market. And it's something that we have to wrap our heads around. We cannot just expect that all of the time the market will be a reflection of rational thought if the mechanics and the physics of the stock market are comprised of things that are not rational. It's that simple. If 90% of what goes on in the market has some origin that is not rational, then 90% of the time it will do things that are not rational. Well, traders can turn that to their advantage, but you also have to watch the risk that develops out of that. And it's just an important point.
This is partially my fault, Tim, with the ETF stuff, because I do the ETF ARB. I do the ETF ARB.
You're it.
And there's no thought going into that. There's zero thought. And our 100 traders at Bright Trading, a lot of them do the ETF ARB as well. And you know what? There's a lot of other prop firms out there doing ETF ARB. So there's no thought going into that. So it's part of I feel partially responsible for what you're talking about.
Well, it's funny you mention that. So we track the spreads every week between sector ETFs and the underlying stocks comprising them. And in the last 2 months, the spreads have absolutely exploded to levels we have never seen before. I mean, if it's on a graph, it is shocking. I don't know if that has any meaning at all, but it's something that has developed just in the last 2 months. And it's why the behavior that is driving whatever part of the market you're looking at is important to me. Speaking of which, EV. I know we've only got like a minute left. And
we got a few more. We'll keep you on. We like you, Tim. You can stay.
You were talking about Tesla and how important Tesla is. And I think I can share my screen, right? I want to show you something that will I think dovetail with that ties in market structure.
Yeah, Tim, just hit that share screen button on the bottom there, and we will be able to see what.
Okay.
There we go. Okay.
Okay, so I think you can see my screen. All right.
Well,
so
can you share a different? There we go. Okay. There we go. I got you.
Okay. So really quickly, this is Edge. So it's a platform that you can use for decision support. And so here is a group of EV stocks. And I want to talk a little briefly about Li Automotive, but let's go to Tesla. And what it will show you is we think of the market this way. there's a log that rolls in the water, and there is a log walker on top of it. And when the log walker is doing really well and moving that log along and staying on top of it, sentiment is above 5. We could say more loved than underloved. And when it's under 5, then there's the risk that the person falls off the log. And you want to be out of these things before you fall off the log. Ones are falling off the log. Anything above 5, like Tesla, still at 8. That's above. That's stuff that can continue to go up. So you're going to see Tesla sentiment. It'll tell you, look, it's bottomed at 8. If it's bottomed above 5, that stock can continue to rise, even though 57% of Tesla is coming from borrowed stock. 57% of the trading volume is borrowed stock. That's okay, so long as it's above 5. Notice that active money is the lead behavior. Very rare anymore to see active money leading. Most of the time, it's passive money or fast trading machines that are going to arbitrage that trade between ETFs and the underlying stocks. But here's the key point. If you want to know why Tesla continues to do so well, just look at the top graph. The dark line is Tesla's price. The lighter colored shaded graph, that's its sentiment, market structure sentiment. And the more time that it spends above 5, the better. Well, look at it since November. It never comes down. And so you stay in Tesla so long as it's above 5. It's that simple. And why is this? Well, it's very simple. There's more demand than supply. And part of that goes right back to ETFs.
Yeah.
Tesla is a huge component now in ETFs. It's one of the top 6 components in ETFs. Well, there's built-in demand, and that will continue until it stops. Look, it stopped here. There was a period where you didn't want to be in Tesla because it stopped being a stock above 5. And it's that simple. And I know, here, let me finish with Lee, and then we'll wrap up because I'm 2 minutes over. But look at Lee. I mean, here's a fact. Lee has been a fantastic stock, but the moment it stops returning above 5, supply exceeds demand, and it's not going to rise. And look where it's been all of December. Sentiment could never get back to 5. Well, unless it can, that is not a stock to own. And you really want to leave when it's 10 out of 10 and short volume is way above trend. There's your point to get out. And this is all market structure. It's something that the reason I think it's so important is it's the physics of the stock market. You can try to track headlines and you'll get, it's happened to me. I lost money on Beyond Meat, so it happens to everyone. But the thing that is most reliable are physics, because it's like gravity. It's a rule of how the market works. And as I said, we'll talk about what makes it stop working and how do you make money using options with this next time. There's so much to talk about.
So Tim, just to expand, so when you said it gets to a 10, you actually sell it because it's just overdone at that point in time?
Well, it depends, right? There's a fine-tuning knob that comes into play. I say stay in stocks that are 10s so long as short volume, the amount of trading volume coming from borrowed stock, stays roughly in line with trend. If it spikes above the trend materially, that's probably a good time to leave. Still might go up a little bit more. But here's Tesla over the last 30 trading days. Well, look, everybody got squeezed here. Short volume became way below trend. So you say, here you're just a little over trend. Yeah, but it's just pegging 10. It's doing fine. So as long as Tesla stays up here above 5, that's good. At 10, you don't necessarily have to sell it. So where's the contrast with Lee? It's the spike. It's the spike. If we back up here, here's the key. Look how high short volume got above trend. That's gonna have to reset. It means that the demand is so overextended because it's coming from borrowed stock that at some point there's going to be a reckoning. Well, I'd rather leave somewhere in here, 10, 10, 10, way above trend. Let's get out. And that's better. You will miss some of the gains, but you will avoid all of the losses that way.
That short volume is interesting too. And now, if you bring up all the major S&P components, probably that short volume is fairly high as well because of the market making aspect. Correct?
45% of all trading volume. You were dead spot on right. And back in November, it got all the way down to 41%. It's a multi-year low, but it's on the way back up again. So good call. You're absolutely right about that. People don't realize that almost half of the trading volume in the market is borrowed stock.
And they look at short interest and they think, well, how is that possible? But the difference is this is traded stock, and this is the market making aspect which you're extracting from it all, because and obviously, and there's also market making rules which people don't realize as well. Most people don't realize that if you're a market maker and you have orders sitting out there, you could actually be long a stock and you have to mark your sales short, because they don't look at your actual position monitor. The regulators look at what you could have. And so they're looking at your open orders. And so, for instance, if I'm long just technically 100 shares of Tesla, but I'm playing a market maker and I have a short order out there for 100 shares of Tesla, I have to mark my sale on my long short, even despite being long the stock, which obviously skews those data higher. But that's all that market making aspect that comes into play there.
There, you're exactly right. I hope everybody is listening to Dennis Dick, because that's exactly right. The SEC gives, this, but a lot of people don't. The SEC gives market makers an exemption from the rules that apply to me if I want to go short a stock. I've got T+3, my agent does, to locate those stock, or I may have to buy in. Whereas a market maker has T+35 and may never have to do it. Why? Because the market is automated. It's impossible for a Hudson River Trading or a Quant Lab or a Two Sigma or Virtu's prop algo, all of those firms to know at any given time what their full exposure is, because they're trading hundreds, if not thousands of things at a time with automated systems, and the SEC granted them an exemption from the requirements that everybody else must follow, because they're so vital to the stability of the marketplace. That's both good news and bad news. But you're precisely right, Dennis.
All right, we'll talk about more of this next week on our next Market Structure Monday. Tim Quast is, I mentioned, the founder and CEO of Modern IR and Market Structure Edge. You can learn more about his platform by going to marketstructureedge.com. Tim, we appreciate it.
Great to see you guys.
Thanks.
We'll talk to you next week.
Sounds good.